Sending money abroad after 1 April 2026? Don't ask for Form 15CA anymore.
From 1 April 2026, Forms 15CA and 15CB have been replaced by Forms 145 and 146 under India's new Income Tax Act. The purpose remains largely the same, but the form numbers and digital filing process have changed.
If your taxable remittance is up to 5 lakh rupees, Part A of Form 45 may apply. If it exceeds 5 lakh rupees, you'll generally need Form 146, the new Chartered Accountant Certificate, unless you've obtained an Assessing Officer Certificate.
One more thing. Don't confuse these forms with the Liberalized Remittance Scheme or tax collected at source. They're separate compliance requirements, and both may need to be considered depending on your transaction. Before sending money abroad, make sure you understand the documentation required.
New form numbers. Same need for proper planning.
The context and mechanics. Why the Income Tax Act 2025 upgraded the system. All right, welcome to today's explainer. If that quick intro caught your attention, you're in exactly the right place. We are unpacking the massive structural shift that just took place under India's Income Tax Act 2025. And let me tell you, this isn't just a simple rebranding of legacy tax forms. It's a complete architectural overhaul of how global wealth moves across borders. Let's look at the mechanics of why this upgrade had to happen.
What's truly fascinating here is the sheer scale of the digitization. In the past, clearing a foreign remittance involved a lot of manual verification. That meant days of frustrating float time where your money was basically just sitting in limbo. Well, not anymore. Authorized dealer banks are now connected directly to the income tax portal via real-time APIs. It's like a digital superhighway. When you submit your forms, the system instantly verifies them. Furthermore, the portal now uses structured dropdowns for over 65 Reserve Bank of India purpose codes. This ensures your tax reporting perfectly matches your exchange-controlled declarations, virtually eradicating the mismatched reporting that used to trigger those dreaded regulatory audits.
The 4 parts of Form 145, the Master Declaration. Mastering this new primary reporting document is absolutely non-negotiable. Getting this right is crucial, because selecting the incorrect part of the form is a guaranteed way to see your transfer instantly rejected by the bank. Notice how the new system routes your compliance based on the size and nature of your transfer. Now, the magic number to remember here is the 5 lakh threshold. If your transfer is taxable but stays under 5 lakh rupees in a financial year, you just need Part A. That's a simple self-declaration. Part D is for non-taxable remittances of any amount. Easy enough, right? But take a look at Part B and Part C. Once your taxable transfer crosses that 5 lakh tipping point, you can no longer do this alone. You must loop in the government through an assessing officer certificate for Part B, or much more commonly, bring in a chartered accountant for Part C. The professional layer. When you need Form 146. So let's see how this compliance builds when your remittance actually pushes past that 5 lakh boundary. Welcome to the professional layer of compliance, which brings us to the brand new Form 146.
Form 146 is the direct replacement for the old Form 15CB, but honestly, it is so much more robust. It's a digital tax determination certificate issued by a chartered accountant. The CA verifies your tax chargeability and checks if you qualify for any double taxation avoidance agreement or DTAA benefits. But here is the most fascinating upgrade. The CA now has to generate a unique document identification number, or UDIN. When you file Form 145, the system instantly links and literally consumes this UDIN in real time. This completely eliminates the risk of anyone using duplicate or fraudulent certificates to clear their funds.
Just a quick pro tip for those of you trying to lower your tax liability through a tax treaty. Under the 2025 Act, you can no longer rely on the legacy Form 10F. Actually, scratch that. You just can't use it at all. You must now ensure your tax residency certificate is updated in the system and file the new Form 41 right alongside your Form 145. It seems like a small detail, I know, but missing it will completely derail your treaty benefits.
The financial impact. Untangling TCS rules. Now remember the warning from the beginning of this explainer? We said, do not confuse your tax declaration forms with the actual taxes collected at the time of transfer. Let's untangle this entirely separate but equally critical compliance layer. Tax collected at source, or TCS, under the Liberalized Remittance Scheme.
Okay, here is exactly where people get tripped up.
We just talked about a 5-lakh threshold for getting a CA certificate, right? Well, forget that number for a second. When we talk about tax collected at source, the threshold you need to worry about is 10 lakhs. If you are a resident Indian transferring funds abroad, this is the number that triggers an upfront tax hit directly at the bank.
Let's look at the actual financial impact. Breaking down the updated TCS rates. If you're sending money for education or medical purposes, it's pretty forgiving, just a 2% tax on the amount exceeding 10 lakhs. Overseas tour packages, they take a flat 2% from the very first rupee. But look at that bottom row. If you are sending money abroad to invest in foreign shares, or maybe you're buying property, anything above 10 lakhs gets hit with a massive 20% tax collected at source. While you can technically claim this back when you file your income tax return, it represents a huge chunk of your cash flow just locked up with the government.
NRI exemptions, who is actually subject to LRS? So, what if you are a non-resident Indian? Here is a critical nuance that most articles and forums get completely wrong when they start worrying about these steep new TCS rules.
The crucial point here is that the liberalized remittance scheme and its hefty 20% TCS is designed specifically for resident Indians. If you are an NRI, under the Foreign Exchange Management Act, you are classified as a non-resident. Therefore, the entire LRS framework simply does not apply to you. If you are just repatriating funds from your NRO account back to your foreign account, you are generally fully exempt from this TCS hit.
But hold on, don't celebrate just yet. Escaping TCS does not mean you escape the forms. No way. If you are an NRI selling property in India or moving rental income from your NRO account to your NRE account abroad, the bank will absolutely refuse to process the transfer until you provide Form 145, or likely Form 146 from your CA to prove that all underlying Indian taxes on that income have been settled. Steps for proper planning. Flawless remittance in 4 steps. All right, we've covered the forms, the thresholds, the digital upgrades, and the exemptions. The whole shebang. Let's map out the chronological order of operations so your next transfer clears without a single hitch.
Here is your blueprint for a flawless remittance under the 2026 rules. Step 1. Identify the exact RBI purpose code from those 65+ categories and verify if the transfer is taxable. Step 2. If it is taxable in over 5 lakhs, hire a CA to generate Form 146 and its associated UDIN. Step 3. Log into the income tax portal, fill out the correct part of Form 145, and link that CA certificate. Finally, Step 4. Submit that digital acknowledgement straight to your bank. Because of that new API integration we talked about, if you follow this sequence exactly, your funds are cleared almost instantly instead of being stuck in compliance purgatory for weeks.
Which leaves us with this final thought. India's cross-border financial tracking is now fully digitized, it operates in real time, and it is relentlessly precise. The days of casual self-reporting and legacy paperwork are totally over. So in this era of API tax tracking, can you really afford to rely on outdated compliance strategies for your global wealth? Make sure you understand the documentation, consult an expert if you cross those thresholds, and plan your remittances wisely. Thank you so much for joining me on this explainer, and I'll catch you in the next one.